Well, let's get started then. If you'll allow me to look at my notes, and I'll welcome everyone to this virtual meeting of the C.A.R.P membership. My name is Anthony Quinn, and I'm the Chief Community and Benefits Officer here in the C.A.R.P National Office, operating from my home in Oakville, Ontario today. Thank you for attending this afternoon, and thank you for being a C.A.R.P member. I did want to take a moment to let you know that we do value your membership very much. As an advocacy association, we are working on your behalf and we exist because of your membership. I do want to ask each of you to help us spread the word about C.A.R.P and ask that you tell your friends about us and let them know that you're a member and that you support our mission to improve the lives of Canadians as we age. The more members we have, the stronger our voice will be and the more effective we can be in our work. So, this meeting is a response to the increasing concern from our members. They're telling us that they're really worried that their savings and investments may not be enough to see them through to the end of their lives. They're worried about outliving their money and becoming a burden on their families or becoming reliant solely on government benefits. So I'd like to introduce you to our three panelists this afternoon. I hope they will help to alleviate some of that financial stress that comes along with our increasing longevity. David Kravitz, in the top left corner of my screen, is my colleague at C.A.R.P, and he's our Chief Membership Officer. He's also a Vice President at Zoomer Media and runs the Zoomer U operations that provide insight to advertisers on the needs and expectation of the demographic we call Zoomers. He's also an author and has written 2 books that look at the societal changes that have been brought about as baby boomers have entered their retirement years. The New Old and Beyond Age Rage, how boomers and seniors are solving the war of generations. And David is also had a storied career as an advertising executive, one of those madmen that I love to watch on television. And he was a partner in the Saffer, Kravitz, and Friedman agency, which was recognized as the leading retail specialist agency in North America. So welcome, David. Good to see you again.
Hi, everybody. Glad to be here.
And Fred, to my bottom right. I've not had the pleasure of meeting Fred, so Fred, welcome. But I have seen him interviewed on numerous occasions and read a number of his insightful articles on finance, and I always come away learning something new. Professionally, he served as the chief actuary of Morneau Chappell until 2018, and is the author of several books exploring Canada's retirement system. One of those is The Essential Retirement Guide, A Contrarian's Perspective, and he has co-authored The Real Retirement, Why You Could Be Better Off Than You Think, and How to Make That Happen, with co-author Bill Morneau, who everyone's name will recognize. In 2018, he published his 3rd book, Retirement Income for Life, Getting More Without Saving More, with a 2nd edition published in 2020. And I think, Fred, I hope to hear a bit about that 2nd edition and the what's happened since COVID and your insight into that. He's also a regular contributor to Canadian publications such as the Globe and Mail, the National Post, and is a fellow of the Canadian Institute of Actuaries. Last but not least, a new colleague of mine, Fraser Stark. Fraser is a president of the Longevity Retirement Platform at Purpose Investments. Purpose is C.A.R.P's new recommended partner, and Fraser will tell us what Purpose has to offer our members in this new longevity platform. He has 20 years of global experience, business leadership with a strong passion for driving change and growth with a focus on software platforms, marketing, and retail and e-commerce. So welcome to David, Fraser, and Fred. I am going to step back as more of a technical controller for the rest of the way, and I'll ask David to start off. And David, you're our resident expert on longevity at C.A.R.P. What's the story behind these years that have been added to our life expectancy?
Well, thank you, Anthony. Hello, everybody, and I'm delighted to be on this panel. I think this is a topic we're going to be coming back to a lot now. And my goal here is on this meeting to sort of set the stage. I am not the financial expert who's going to tell everybody buy this, sell that, but I want to set the climate. And I'm actually glad you mentioned my ad career, Anthony, because I want to open with an advertising story that dates me, but I bet many members of our audience will remember this famous campaign. I think it was by London Life when we were all in our young adulthood of Freedom 55. How many people remember Freedom 55? Well, as a result of longevity, it's now been rebranded as Freedom 95. Or another way of looking at it is Freedom 55 means I have to keep working till my kids turn 55. Somebody once told me that, semi in jest. But really, when you think about it, the whole topic didn't used to exist, because when Freedom 55 was a famous one of many retirement plans, life was in three stages. You were educated till you were in your young 20s, maybe. You worked till you were in your mid 60s, phase two, working. And bing, on the stroke of midnight at 65, you retired. And hopefully you had a good enough package. But even if you didn't, I mean, you only had 10, 12 years to go statistically until you were done. And you didn't need to think much beyond that. Today, a 65-year-old has a 50-50 shot at seeing his 90s or her 90s. And the fastest growing age group in our society are actually centenarians, if you look at percentage terms. We are already in North America at the point where the over 60 population outnumbers the under 14 population. Never happened before in history. And although it's not on our topic today, I'll mention to you that some societies, they're actually heading for an upside down population curve, where they're actually going to lose people. 21 countries on the planet Earth today are going to have fewer people at the end of the century because the older people are living longer. There's no birth, or the birth rates have collapsed. So the balance is tilting toward older and older populations. China could lose 700 million people. It could actually have a half the size that it is today. And they are already freaking out in China, I can tell you. And I know that Fred and Fraser know more about central banks and what worries them, but they're already freaking out by the prospect of an upside down pie with far fewer younger workers supporting far more older workers. So we're all going to live longer. What do we do about it? And I want to give you just a few quick numbers, and then I'll turn it over to the experts. So one of the early things we're seeing before we even get into the world of financial and investment vehicles is that the definition of retirement, that automatic stroke of midnight 65, you are now retired, that is gone. And one approach to I need more income, my pension isn't enough, I'm just going to keep working. So here's an example. So in 2011, 10 years ago, there were 4.7 million Canadians over the age of 65. I'm using 65 because that's the traditional retirement age. It doesn't need to be, but it always has been. 4.7 million Canadians. 91% of them were either semi-retired or fully retired. 91% of them. 3.2% were semi-retired, 88.9% were fully retired, 91% were retired or semi, which means that 9% were still working. And that added up to 423,000 people in 2011 over the age of 65. And I would stress here, a little note to Fred, I'm making marketing statistics points here, not actuarial points, because my math is primitive compared to yours, but I'll keep going. So 423,000 people over the age of 65 had not retired at all. Today, 10 years later, 6.9 million people over the age of 65. And out of those, 84% are either semi or fully. So almost 10 full percentage points less, which means that 16% are still working in one form or another, which means 1.1 million people, almost 3 times the number, are still working. So there's a lot of fluidity in what retirement means, and are you still working? And we're going to see that change more and more. So now, if that's changing, if the notion of employment is changing from part-time, side hustle, side business, boomers are the number one buyers of work-at-home franchises. If all that's changing, why should we expect the world of financial investments and vehicles and investment solutions that are open to you, why should we expect that world to be frozen in time, that nothing's moved since Freedom 55? And the good news is that that community, the financial community, the investment community, is adapting. We can debate whether it's happening fast enough to say, hey, we got to rethink this whole logic. We're not back in the world of Freedom 55. We need to come up with new products, new services, new ways of looking at this to accommodate longevity, not so that we're not just saying you're stuck with whatever investment devices you had 30 years ago. Your only choice is to keep working or not. No, you can keep working, but that's only part of it. The financial services sector is going to respond with innovative new solutions and innovative new ideas. And that's why we were so excited to get together with the folks at Purpose, because they're thinking it through. They're thinking about these things and they're coming up with those kinds of answers. And all we are asking, or all we're trying to do with forums such as these, is to get our members at least aware of that you should know what's going on out there, because our members are very open, if you're on this broadcast, to those ideas. So some quick things. Now, 14%, 1 million Zoomers say they are actively looking for new ideas. 5 million out of the 6.9 million say that financial security for retirement is each individual's responsibility. They want to know the information. They want to do, they want to know, they want to learn. 391,000 people who are 65 plus have electronic, EFTs. I'm sorry, ETFs, exchange traded funds, which is a relatively new, but they're moving into it. Does it make sense for everybody? Does every single person have to? No, but you do need to know what's out there. So this meeting today, this webinar today is in the spirit of giving you new information about what's out there so that you incorporate it into your thinking. We're not saying that one size fits all. We're not saying one answers for everybody, but C.A.R.P feels we do have a responsibility, since there is so much change and there is so much creativity in that sector. We think we have a responsibility to bring those new ideas to our membership. And that's why we're very delighted at this event. And I actually think, and I think we've talked about this with some of the folks at Purpose, that we think this is an ongoing process. We think this is the first of many, and that we will constantly be updating you and bringing you new ideas. So with that in mind, I'd like to thank everybody again for being here. I've kind of tried to set the stage of what we're trying to do. And I think I'm turning it over to Fred now.
David, yeah, thanks. What's your sense of that graying workforce? Are they continuing to stay engaged in the workforce out of interest, out of need, out of understanding that they're looking down a longer runway than perhaps their parents did, and they want to remain in the workforce for that longer period of time? What's the sense there?
It's a great question. And for the purpose of today, we're talking about need. We're talking about where am I going to get enough income? Because if I'm 65 years old and I think I've got a 50-50 shot at 90, I need a lot of money and very few retirement plans. And if I'm not on a big pension, where am I going to get that money? However, another reason that's motivating this, of course, is desire, not just need. It's known that if you stay in the workforce long, depending on what job you're in, there are health benefits, there are mental acuity benefits. I'm sharp, I'm engaged, I'm in the game, I'm still part of the deal. A lot of people that don't even need the money are buying a small business, they're running that side hustle, and luckily the gig economy is playing right into that. And so a lot of people want to keep going because they want to keep going, because they don't want to just stop. And there have been studies that have shown that when you retire abruptly, even in good health, there start to become health problems. What are you going to do? So some of that engagement might be volunteering. It might not be working for pay. It might be, I'll take a big cut in income, but I like that little bookshop that I always dreamed of owning, or that little side hustle I always dreamed of doing. So it could be a mixture of need and desire. And particularly baby boomers, who have always been kind of type A as a generation, and go. And why do I need to get off stage now? Why do I need to retire into the shadows just because I've hit a certain age if I can keep going? And it's a whole other topic, but I mean, we've got, if you take a look at the work schedule, that was maintained by Prince Philip, rest his soul, up until 2 or 3 years ago. The Queen, if they try looking at her Outlook calendar and keeping up with that, even at her age. So we're in an era where it's quite with many examples of people are going and going and going. So that's certainly part of it, and that we could do a whole bunch of webinars about that. For today, it's about the dollars and cents. How do I keep that income coming in for more years?
No, our members do tell us that they are concerned about outliving their money. And Fred, maybe we'll go to you. Gentlemen, I do want you to have a conversation amongst yourselves, but Fred, should our members, should everyone watching today, should they be concerned about outliving their money?
Some should. The ones who haven't got defined benefit plans with the government probably should be somewhat concerned. Although if they do all the right things, which I tried to outline in my third book, Retirement Income for Life, I think those concerns could be minimized. But would you like me to start with my
Yeah, please go ahead.
Okay, sure. Okay, well, my name is Frederick Batiste, and I was chief actuary for 27 years at Morneau Chappelle. I think it's Canada's largest human resources firm, including the actuarial practice. Just to manage your expectations, I am an actuary, and should remind you of the old joke of the definition of an extroverted actuary. When he talks, he looks at your shoes when he talks to you. So there you go. So anyway, having said that, we are supposed to be experts in risk management, and if that's maybe too nebulous a term, we're the ones who figure out how much money corporations ought to be putting into pension plans, how much the government should be contributing toward, and individuals should put into the Canada Pension Plan, what insurance should cost, and so on. So we're the ones who calculate all that, taking risk into account, taking more longevity into account, investment returns, and so on and so forth. So that's what we do. And I've been doing this since the 1970s. This is my field of expertise, if you wish. So maybe I'd like to start off by just giving you a very broad sweep of how we got to where we are today. And basically, the Canadian retirement income system really grew up in the 1960s and 1970s. This is when, for example, RSPs were introduced in 57, but they really took off in the late 1960s. The 60s is when they introduced the Canada Pension Plan, when they formalized and expanded upon the old age security pensions, when they introduced GICs, and so on. So all these things happened in that period of time. I came in, started working at Mercer in 1976, and this was the heyday for defined benefit pension plans. And I know some of the people on this call would have those plans. Defined benefit or DB plans are the kind of plans people like to have because they minimize uncertainty, they minimize risk for the most part for individuals. In some cases, they totally take away the risk from employees because the risk is all handled by the plan sponsor or by the employer. Now, the thing is, DB pension plans, and actually the whole private sector workplace pensions, they peaked back in 1977. At that point in time, 47% of the workforce was covered by such plans. And there were grand hopes that would keep on increasing until most of the workforce was going to be covered by them. What happened, though, was just the opposite. That ended up being the year in which coverage in private workplace pension plans actually peaked, 1977. Thereafter, it went down from 46% down to 37%, where I think it's around that percentage today. And the reason why it's even that high is because it does include the public sector, where almost 100% of workers are covered by pension plans. If you look at just the private sector, you're probably looking at, and don't quote me on this number, but it's roughly 25% of people in the private sector are covered by a plan of some sort. Now, they're not covered so much by DB plans anymore. For the most part, those plans were frozen or phased out or wound up quite a while ago, all in the last 30 years. And so these plans are largely closed plans. And I can name so many large plan sponsors who used to swear up and down that they really believed in the DB model and they would never ever abandon it. And they abandoned it to companies like 3M, Molson, RBC, Bell Canada, and so on and so forth. So this is what's happened in Canada over that period. Now, some of that in fact, much of that slack was taken up by DC plans, DC defined contribution. You think of it as a kind of an RRSP that's formalized as a pension plan scheme. So DC plans, as you can imagine, leave almost all the risk to the individual. And so these are the kind of plans that people are now retiring with. And sometimes they were actually covered by a DC employer, DC pension plan. More often they would simply put money into their own RRSPs. And that's what they're now retiring with. And it didn't used to be a big problem because it wasn't a mature system 20 years ago, because that's when they were converting from DB to DC plans. But now these plans are maturing. And we now have over 1,000 Canadians who are reaching age 65 every day. So it's becoming a big problem. And the trouble with DC plans is that for the most part, employers kind of leave people to their own devices when they retire. They might have been building up a nice account balance in one of these plans over 20 or 30 or 40 years. But all of a sudden they're now the employer says, well, now you take care of it yourself, find yourself an advisor, go to a bank, whatever, but do what you have to do, but take the money out of our plan and take care of it yourself. And that's kind of, so that's kind of where we are today. We have people who are concerned because they are not covered by DB plans, they're covered by DC or group RSPs or just individual RSPs. And they got to figure out a way to make their money last for a lifetime.
Sorry, Fred, for those, that it's a smaller percentage than not that have some kind of plan, DC or DB, especially in the private sector. What are they looking at by way of OAS, GIS, CPP if they've been working in Canada? How far can they get down the road with those kind of plans?
Okay, so you have to kind of segment the population by income level. If you're looking at people who are in the lowest quartile of income, and that might be earnings level up to say 30,000 for an individual, maybe close to 50,000 for a couple. But the lowest income level, they're actually going to be better off in retirement than they were when they were working. They'll actually have more disposable income because they will get some income from CPP, income from old age security, and also from GIS, their guaranteed income supplement. And with those three sources, they'll get more money after 65 than they ever had when they were working. So that I'm not so concerned about them because the Canadian government and our Canadian system actually takes care of them fairly well. I'm looking more at the middle income workers, and these are the ones who are now stuck in DC plans or RSPs and who have to somehow figure it out for themselves. And the reason why it's become such a big challenge is because investment returns aren't what they used to be. 30 years ago, the real return, that's the after inflation return on government bonds, used to be 4% or even close to 5% for a while. And this was a guaranteed return that they could get. Today, real returns on government bonds are 0%. Similarly, the last 30 years have been a great time to be invested in stocks, and notwithstanding what happened in 2008, 2009. And the real return, once again, after inflation on stocks was about 8% during that period in time. And I don't know if you saw my article that appeared in the Globe and Mail last Saturday, but it's not even a guess, it's almost a certainty, mathematical certainty, that the real return's got to be much lower than that in the future. And I'm estimating it's going to be somewhere between 3 and 5% instead of 8%. So it's going to be a challenge for people to achieve the same kind of to the extent that they're expecting investment income on their savings, and that's going to tide them through in their retirement. It's going to be more difficult. So that's what I dealt with in my book, Retirement Income for Life. How do you turn a lump sum into a regular, reliable stream of income? And so the tricks or the enhancements that you use, one of them is just minimize what you pay to suppliers. The biggest one being investment managers. You don't always get what you pay for when it comes to investments, so you want to make sure that you're minimizing unnecessary fees, and that's a big one right there. Second one would be trying to maximize. Remember, we talked about DB. Well, you still do get some DB pension. That's from the Canada Pension Plan and Old Age Security. That is essentially a defined benefit for the rest of your life. You want to maximize that to the extent you can. And so I've been a big proponent of deferring starting your CPP pension until age 70, something which is hugely unpopular with Canadians. And we can get into why that would be, but it is hugely unpopular with Canadians. But that is another way to make sure your money does last for a lifetime. And the third one would be, once again, looking at another kind of a DB source, and that's annuities. Now, between the first edition of Retirement Income for Life and second edition, I've become a lot less enamored with annuities than they used to be. Interest rates have gotten so low that annuities are expensive. By expensive, I mean the amount, if for a given amount that you put into an annuity, call it $50,000, you're getting much less income than you used to get. And it's kind of a hard sell. The way I analyze it is, if you actually do end up having terrible returns on your regular investments and you live a long time, you're still better off with an annuity than without, but not that much better off. And those two things have to happen, i.e. longevity and bad returns. So that's why I was really pleased to see Purpose coming out with a new product. Being the but before we get into that, though, I just want to talk a little bit about the longevity trend. One reason we think we have to, it's going to become more of a challenge to I guess, have our money last a lifetime, is because we're living longer. And we are to some extent. There's no question about it that there have been mortality improvements. They've slowed down over the last few years for reasons which are kind of unknown. In fact, they even reverse themselves in the United States. But nevertheless, we still are living somewhat longer. But I want to make it clear as to what that really means. The maximum age people can live to seems to be about 115, maybe 120. There was one French woman who lived, I think, until 122. But generally, when you hear about the oldest person in the world, they're about 115 years of age. Now, that maximum age hasn't changed over the last few decades or even centuries, really. It's always been about the same. What we've done in order to increase our life expectancies is we've kind of carved out mortality up until that age, especially in our 70s, 80s, and 90s. So the mortality rates have been dropping in those decades, but we really haven't changed our maximum. So you don't have a maximum lifespan. You don't have to be too worried about living beyond 115, because it just isn't going to happen. However, I'll take David's point, where there are a lot more centenarians than there used to be. I'm not sure I want to be one of them eventually, but I'm sure many people do. So that's kind of what's happening with longevity. So yeah, I think generally, if you look at your parents and your grandparents and what age they live to, that'll probably be your fate as well, but maybe add a couple of years onto that. So anyway, but as I was saying, annuities used to be the third plank in my scheme for ensuring people actually don't outlive their savings. And I was pretty ambivalent about them in my second edition to my book. Now I actually became a member of the Retirement Advisory Board at Purpose about a year ago or so. And if I am gung ho on their Purpose Longevity Fund that Ray Fraser is going to be talking about, it's not because I'm on the board; it's the other way around. I got on the board because I like the product. I've been modeling it to some extent already, and here's how I would characterize it. If investments do anywhere near like middle in the road kind of returns in the future, then you'll actually be better off being in the Purpose Longevity Fund, maybe even much better off than you would with an annuity. If investments do terribly in the future, then yes, you would probably be a little better off with annuities. But it seems like it's going to be the best solution for a lot of people. Now, I would never suggest anyone put 100% of their nest egg into that kind of vehicle. I kind of like 30-35% as being the portion of their assets that they put into that vehicle. I just don't believe in putting all your eggs in one basket. So I know I've kind of meandered all over the place, and maybe I'll stop there and ask if there's any questions, or I should be directed.
No, thanks very much, Fred. I think we'll go right around the horn here, and we'll hear from Fraser and then maybe have a little discussion. But as you mentioned, Purpose Investment is someone that C.A.R.P has recently partnered with as a C.A.R.P recommended partner, because we, like you, we saw something that was novel and was a response to what our members were looking for. Now, Fraser, if you could walk us through a bit about Purpose and your goals and mission, and then a bit about this this pension income fund that you have available, and who might it be suitable for.
Yeah, thanks, Anthony. Let me share my screen here. I've got a few slides. We'll try to go through pretty quickly. So I'll start by telling you about Purpose Investments. So the company was founded in 2013 by Som Safe. Those of you who fly Air Canada will know Som from the ads that run before the videos. Many people across the country are familiar with him. The mandate of the firm is to provide both retail and institutional investors with what we call outcome-oriented investment products. And so these are investment vehicles that help the investor achieve a very specific outcome. And it's a bit of a unique approach to investing that we find very effective. Today, we manage 12 billion in assets. I actually heard earlier this week it may have crossed 13 billion, but the official number currently is 12 billion under management. And wherever we can, we make these strategies and these funds available as ETFs, as David mentioned earlier, and as mutual funds. We'll get into it with the longevity pension fund in a minute. It's done as a mutual fund, and I'm happy to explain why. But we're trying to create as much access to investors as possible. Our investment capabilities are deep and focused across alternatives, fixed income, equities, and privates. And again, we really focus on delivering specific outcomes for investors. The firm is majority owned by its employees, and we're backed by OMERS Pension Fund, by Torquest, the financial private equity firm, and Allianz, the global insurance company. Now, I won't read through all of these principles, but I'll just share that we're driven very much by our principles. And up in the upper left, you see that idea of outcomes over benchmarks. I think that's a critical idea for us, and it relates perfectly to how the Longevity Pension Fund has been designed to help retirees deliver on the outcome that they're looking for, which is a great and fulfilling retirement. In the upper right corner, we always think about ESG, that environment, social, and governance layer that's become increasingly important as investors think about having positive impact in the world. There's 6 principles here. I won't go through them all for the sake of time, but these are what really guide everything we do, including the Longevity Pension Fund. Now, Purpose, of course, manages products for a number of outcomes. But with longevity, what we're trying to do is create a holistic retirement experience for people, to really build a platform that helps retirees in Canada live the best life they can in retirement. And so you see on the bottom there, the Longevity Pension Fund is the core, it's the foundation of that, this income solution that provides income for life. And I'll explain it more in a minute. But layering on top of that, we also think about things like, how do you educate people so that they're aware of what's out there and their options and how to live that best retirement life? How do you build a community so that people can come together? We've already heard today from David the power of social connection in order to be healthy and well in retirement. So these are important concepts. We think a lot about retirement planning and tools. That middle column here, how do you make good decisions and understand what you're facing in retirement so that you can take appropriate actions? And then finally, we even think about additional financial services as part of this holistic retirement experience. That could be things like other insurance products. Annuities can be an interesting product for certain people in certain circumstances. How do you have access to the equity in your home? A lot of retired people, the majority of their net worth, or a good portion of it, is actually locked into their home. And so how do you give people access to that in an effective way? These aren't products we're licensed for today as a firm, but certainly things we could do with partners or become licensed for. So, this is our vision, and the firm's been thinking about this, and Som personally thinking about this for many years, as really a huge pillar of what purpose can be and how it can affect people's lives positively. Now, our ambition here, or our mantra, is ambition never retires. And I think that's our guiding principle with this and sort of why we've built this product and this platform. Now, we've touched on some of the demographics, but this is really what guided the firm to launch this product. There's a huge shift happening around the world. It's a long and steady shift towards people living longer. I won't read all of these statistics, but we already heard how someone who's turning 65 today is actually quite likely to live past 90. And if you think about that statistic for a couple, 2 people around 65, of course, there's even greater chance that one of them will live past 90. And as couples plan for the partnership rather than for an individual person, that's a critical point. And because 500,000 people or more each year in Canada are reaching retirement age, as Fred noted, that's more than 1,000 a day. And so this is a real issue. People are living longer in retirement. It's not a decade post-work. For some people, if you do live the Freedom 55 thing, you could live only the first half of your life pre-retirement and the second half of your life in retirement. So the way you think about saving for that and financing your retirement is very different. Now, around the world, I won't cite all these statistics, but around the world, the same trends are playing out as in Canada. And I think that's very powerful. Now, we also come at this from the perspective of what is a person's financial journey throughout their life. We start from the time we're 0 to 18. We're really part of our parents, our families' care in some sense. We don't have our own unique financial identity. When we turn 18 or start getting our first job, we enter the financial world, and there's lots of products we need. Maybe in our 30s, we buy a house or have a kid. In our 40s and 50s, we start to really accumulate wealth. We start to think about what that next chapter is going to look like. And we think about this point T, which is the point that, whether it's 65 or a different age, doesn't really matter. People have more flexibility today in exactly when they retire. But we all hit a point where we're no longer accumulating wealth, right? The majority of our working years and our income producing years are behind us. We're now what we call decumulating wealth. And so this blue triangle is a very rough approximation of what someone's assets might look like. Around 20, we start to build some up. At a point T, it reaches a peak. And from that point forward, a lot changes. Things get more complex. There's unique things we're thinking about now. It's tax and estate planning. It's wills. It's further life insurance. Home equity solutions, like I mentioned a moment ago. And our view is that this accumulation phase from about 20 to retirement is really where the financial sector has focused its efforts and its innovation over the last number of years. There's not been as much focus on decumulation. How do you help people whose working years or prime income years are behind them? How do you help them decumulate while still reaching their dreams in retirement and following that mantra of ambition never retires? Now, the biggest question we hear from people, and we hear this all the time, it comes through in surveys, we hear it personally from people, I'm sure some of you have felt this, is this question, will my money last? It's different than the question of, do I have enough? I think for much of our lives, we think, can I be saving more? Should I be saving more? But at some point, the question changes to, will my money last? And it's a fundamental one, driven by the fact that we don't know how long it has to last for. We just heard some statistics from Fred about, longevity. The oldest Canadian made it to 116 and a half. But some people pass away shortly after retiring, unfortunately. And so it's that uncertainty that drives the challenge of this question and the deep challenge in how to spend in retirement when we look at our statements and see that we've got a certain amount of assets, we've got government supports in various programs, maybe family support as well. But that's the fundamental question here. Now, I won't try to bore you, or I'll try not to bore you with too many statistic slides, but I wanted to share this one because I think it illuminates just what's driving this fear. So this is the life expectancy table for a 65-year-old. I've phrased it here as how many more years of income do I require? And on average, a 65-year-old in Canada, on the actuarial table we've used here, is around 87, 21.7 additional years from 65, so around to 87. Now, someone at this point is looking at different options for how long they might live. And if they want to be really conservative with their money and make sure that they don't run out, they might say, well, let me assume I live to be 105, so I need 40 more years of income. And then that means they'd be almost certain to not run out of money before they pass away. Now, someone else might say, I don't want to play it that safe. I don't want to risk passing away with all my money still in the bank. I'm going to play it a bit more conservatively and say, maybe 30 years to 95. Now, that person actually has a more meaningful chance. There's a greater chance that they live past that. But you can see what's happening here. You're faced with an uncertain amount of years left, and that makes it very hard to know how to invest and spend in retirement and what's possible in your life. Now, if I advance this, you can see here, this other chart on the bottom is not looking at a single 65-year-old. We're now looking at 1,000 65-year-olds. This is, you can think of this as a group of people who have pooled their longevity into one common pool. And you can see there, those green bars, it's not wide like it was before. It's really, really narrow, right? And that's just the law of large numbers and statistics. It's saying if you group 1,000 people, you can bet that not all of them are going to live to be 105, and not all of them are going to pass away early. There's a distribution around that. It's the same average, but it's a much tighter distribution of outcomes. And so what that means is that the chance that someone, a 65-year-old outlives that average of 87 by a year or more is about 46%. They've got a very high chance of outliving that average. If you look at it, though, for that group of 1,000 people, because of this effect of pooling the risk, the chance that the group outlives the average by more than a year is actually 0%. It's not perfectly zero. It's 0.000 something. It's a very, very small chance. And that's the effect of longevity risk pooling. And as we've heard today, whether it's a defined benefit pension plan that gives you that income as long as you live, and there's trade-offs to that, or an annuity that effectively does the same thing in a different structure. These are ways of someone basically moving from that top chart in some sense down towards the bottom chart. And it's what we've tried to do with the longevity pension fund. We've heard about these problems today. If you think about it across three categories, this challenge of decumulation and people in retirement, working with their assets, personal retirement savings. Most of us, 70%, are worried that we're not saving enough. And yet only 23% consider it a top priority. And maybe those statistics are related. I think Fred outlined very nicely how the shift, I didn't realize it was 1977. I hope it wasn't Fred's entrance into the industry that caused it. I'm sure it wasn't. But you've got this movement away from defined benefit pension plans, and it's now very low, the portion of people that have that. And government plans, they're great. We're very fortunate to have them. They could be improved, and lots of us want to see them improved. But they're not integrated across the federal and provincial system. And often they're based on old demographics. So changes that are happening to cost of living, changes to life expectancy are not rolled in yet. They take a long time to roll through. And so they're a little bit out of date in their structure sometimes. So there are products here today that people are using, and most people in retirement, I'm sure many of you, are effectively solving this problem or working on it with the tools out there. These lifetime annuities, they have longevity risk pooling. They provide that insurance policy against living well beyond the mean age, and I think that's really important. But a lot of people don't buy them, right? There's this irrevocability. They can't be redeemed in many cases. It's a binding contract. And that's a big problem. And as we heard, with interest rates where they are, the yield that you get on them, the price per dollar of income is actually quite high. Products like GLWBs are an annuity type with added riders that give you minimum benefits on them. And
Sorry, Fraser, can you tell me what a GLWB is?
Yeah, guaranteed lifetime withdrawal benefit. It's a type of annuity that has additional clauses on it, and they can be structured in different ways, but they effectively give it a bit more guarantee from the person's perspective, and also tie it a bit more to markets, which is helpful, and it's attractive. But again, in this environment, the rates are lower than most people expect, and so these products also didn't make it through the financial crisis very well. So it's a very uncommon product out there now, and it's interesting, and some people use them, but it's certainly not the solution I think people had anticipated. And mutual funds and ETFs, the idea of a balanced portfolio of stocks and bonds. These are fantastic ways to save for retirement, and they can be used in retirement to generate income. Many people do, and they do it effectively, but they don't address the underlying longevity risk. You still have to pick where you want to be on that distribution curve I showed above. And so it leaves investors a bit anxious about how exactly to spend this. So the products that are out there today are useful, but they don't fully solve the problem. And it's why we brought innovation to the market. So I'm here, I'll keep this brief on the longevity pension fund, but what we've released back in June is the first income for life product or solution built on the mutual fund structure. So this is sold just like other mutual funds you might have bought, but it combines those critical elements of a DB pension plan, right? That predictable income that you know is coming, with the benefits of traditional investments, that idea of transparency and liquidity. Now, what we've created here is a construct where investors can always access the lesser of the current value of the fund or their unpaid capital. Now, unpaid capital is defined as the initial investment someone makes in the fund less the distributions they've received from it. This is an income type product. It pays monthly distributions. And we wanted people to know that if you ever wanted your money back or you pass away before you've received back as much as you put in, that you can get that payment, again, voluntarily or at death to your estate. And that's a critical feature that improves upon the structure of an annuity. And it's that feature that builds in this idea of longevity risk pooling and makes it like a DB pension or an annuity in that sense. We've structured this as an open-ended product, and so retirees can continuously invest. You can put in one time, you can put in monthly, you can drip back in or reinvest your distributions. Very flexible. And someone wanting some of their money out of this product, you don't need to cash it all in. You can take just a portion out. Now, the structure of it, everything we've engineered into this and designed allows for superior income payments. So for people 65 to 67 today, the fund yields 6.15%. And it's actually higher for people as they're older. We do this through cohorts, which I'll explain in a second, 3 birth years grouped together. And so people that are in our oldest cohort, 74 to 76, the yield is actually 7.4%. So these rates are much higher than people are used to seeing with annuities that from an insurance company. And that's, the benefit of keeping money invested in the market. Now, these rates are not guaranteed. This is not a contract between an insurance company and a client. It is an investment vehicle. The funds are invested in a balanced portfolio of stocks, bonds, alternative assets. We use various derivative strategies in order to reduce volatility and make the returns as predictable as possible. But it is an investment product. These rates are designed to go up, and in most cases they do, but they can go up or down with the markets. Finally, the fund structure is portable, so it can plug into a defined contribution program or plan and create a bit of a defined benefit-like model for the investors who hold those units. I'll go through this quickly. I do want time for questions. The cohorting structure, as I mentioned, there's 4 cohorts today, 3 birth years, 1945 to 47. The youngest one that's in the decumulation cohort is 1954 to 56. And for people who are still working, those under 65, they can buy in to the accumulation class, save for retirement, and it automatically rolls over into decumulation units. So it's a great way to save for retirement and seamlessly roll over. Now, we want this to be seen as part of the broader Canadian retirement income system. The government programs we've talked about today, CPP, QPP, OAS, these are bedrock foundations of anyone's retirement. Workplace programs, even though they're changing in nature and to some degree declining, they're still important programs. And personal savings will always be a big part of the retirement picture. But if people can take some of those personal savings or a workplace program and put them into the longevity pension fund, they're able to ensure that they've got income for life and have the peace of mind that comes with that. The financial community has picked up on this. There's been a lot of great press on the product from, Rob Carrick in the Globe and Mail, a very well-known author, Jonathan Chevreau in Money Sense, and he writes for others, as well as bloggers like Don Ezra and numerous others who've really heralded the idea that we're innovating here. This is Canada-led. We've got a ton of interest from around the world. It's truly innovative. And it's a great product for some people to consider for, as Fred said, a portion of their portfolio. And I think this is the final slide. Fred alluded to our advisory committee. We know that this is a complex problem to solve. Retirement is a very intricate financial topic. It's an intricate human topic as well. So we've got these 4 members of the advisory committee: Fred, who you met today, Jim Leach, who used to manage the Ontario Teachers Pension Plan and then ran Queen's University as Chancellor, Keith Ambekshire, who is a well-known global consultant on DB and DC pensions, and Bonnie Jean McDonald, one of the leading academics doing research into the evolving retirement finance systems. And so these four people have just been fantastic at helping guide us, bring that expertise, and help us design these products and sort of see around the corner to what's coming next. I think I'm obligated to show this disclaimer slide briefly and a slide on risks. But thank you for your interest. I look forward to taking some questions along with David and Fred.
Thanks very much, Fraser. It's a lot to take in a short period of time, and I think what I've heard from you every time we've spoken is that individuals should be getting their own best financial advice from an outside advisor. We're not here selling mutual funds at C.A.R.P, but we do think this is an important product. It really does connect to many situations in our demographic, and we wanted to share more information about it. David, just back to you perhaps on how C.A.R.P gets involved with an investment company for the first time. What brought us to have this connection?
Well, I think what brought us is the thought process and the interest in the topic of longevity and the awareness that the ball game has changed, and that new creativity and new solutions need to be developed. And as you said, we're not necessarily recommending change everything and put everything in here. It's not for everybody, but what is for everybody is the topic and the need to keep informed about the new developments that are going on. We've also talked with the folks at Purpose about some of the other pillars that Fraser mentioned at the beginning, such as education, such as ongoing dialogue, such as the synthesis, which I predict is coming. And I think some of the folks at Purpose have agreed with me, even though it's not today's topic, of a tighter synthesis between career and income and employment and part-time employment and investment. What's the intersection of those worlds, and what fresh thinking can we bring to the investment community? Can they bring back to the job community, so that you have a balanced strategy when you enter that decumulation stage? And I noticed on Fraser's chart that decumulation included income solutions. And they may not only come from an investment vehicle, they may come from employment. And when you sit down with your financial planner, and there's a lot of literature on this, and I'm sure if I'm seeing it, Fraser and Fred must be seeing it times 10, of financial advisors now saying, there's nothing wrong with me taking into account in building out your future plan part-time employment, semi-employment, like it becomes a building block of the actual program. So we wanted to find people we could have those kinds of discussions with, and they weren't siloed into, we only do this type of investment, leave me alone, or it's somebody else's problem. So it was more the breadth of their focus and the opportunities for creative dialogue that I think led us there.
Thanks,
and
David.
this is one product, and our members can evaluate it, and there's more to come.
Fred, you mentioned that one way for people to not outlive their savings was to lower their cost of investments. And one of the questions, Fraser, we received in the chat here was, what is this going to cost me to invest in the Purpose Fund?
Yeah, so I guess that's for me. So the management fee on this is 60 basis points, 0.6%, and it's a fund of funds, and we've invested across approximately a dozen other Purpose funds. The fee, that 60 basis point fee, is inclusive of all of that. So we've managed to keep the fee. We feel it's very reasonable for this. There's a wide range of product fees out there. You can pay very little for index funds. You can pay a lot for actively managed strategies. As you can see, I hope it came across with the structure of the fund. We're doing a lot here. We're investing time and effort in managing this effectively to achieve that outcome that I mentioned. And so 60 basis points is a reasonable fee for that.
And the other question I just saw come across the screen was about that age cohort. If you are above that threshold, was it 1937?
Born before 47,
45.
yeah, 45.
So what what are the options with the purpose investments for them?
Yeah, we're not able to offer it to people born before 1945, and that has to do with Fred's area of expertise, the sort of actuarial science behind it. We worked with his firm, Morneau Chappelle, now called LifeWorks. He wasn't there at the time. I think he'd retired already, but we worked with the firm and on the actuarial modeling. And one of their suggestions was you need to close the fund around the time people turn 80 to new investors. There's reasons I won't go into now why it's not possible. We hope to add one more cohort down the road for people born 1942 to 44, but that will be it. There won't be cohorts for people before that, and we're not certain. I can't announce today that we are doing that. So for people in those ages, I would point to annuities, to be quite honest. I think those could be an effective solution. I don't know the pricing of annuities at that age, and I know that annuities also have a point at which they stop being issued. But we're incredibly in favor of the idea of building longevity risk in protection into your portfolio, and we offer one way to do it. There are trade-offs. You don't. This is not a guaranteed product, while an annuity is. What that guarantee is expensive, and so to get a guarantee, you accept an expectation of lower return. But for someone who can't buy into the longevity pension fund, I would take a close look at annuities, and I would read Fred's book because I think he's got some great advice in there as well.
And Fred, you mentioned that after someone perhaps retires from a career and they have been given a lump sum from their defined contribution plan, they're sitting on an X number of dollars as a nest egg. And would something like this purpose longevity fund be a way for them to invest some of that, if not, what you said 30-odd%? What would they do if they've come into either a defined contribution plan payout or they've downsized their home and they're sitting on some investable money?
I think it makes a lot of sense if they're in one of those age cohorts that Fraser was talking about. It makes an incredible amount of sense for them to be thinking about putting in about 30%. I wouldn't put in 50, and I wouldn't bother if it's below 10%, but 30% seems to be like the ideal amount to be putting into something like this. I'd say people on this call should be looking hard at how the product works exactly. The fact that it does pay you more and more as you get older, and as some of the people in that cohort die, you're actually receiving more when that ends up happening. Take all that into account, and you're going to find that you'll be better off doing this than an annuity, as long as the investment returns are at least somewhere close to average.
So Fraser, it is a new product. What have you seen, or how would you describe the type of investors that have come in thus far?
Yeah, we're seeing a really wide range of investors. So, there's people buying into both the decumulation class in retirement and the accumulation class. People are buying in both inside and outside RSPs and RIFs and TFSAs. So there's a wide variety of options. I think we'd thought initially that the demand would be concentrated in decumulation class units inside tax sheltered accounts. We are seeing that, but we're also seeing much broader interest. It's still early days. We recognize a fund like this, where people are investing for a 30 to 50 year. Some people at 65 will live another 50 years. I look forward to someone hitting 115 while still receiving income from this. And so we're going to see that evolve over time. But right now we're getting a broad range of interest across the board.
And that was another one of the questions that came up. Where can you hold these funds and how are they taxed? And I guess that the response is it depends on where you're holding them.
That's right. And we've got, there's some information on our website, retirewithlongevity.com. There's an FAQ that gets into some tax questions. And we can also share, if someone could put that in the chat, just retirewithlongevity.com for people, the Q&A section. And then we've got a tax primer, because the tax treatment on a fund like this is interesting. There's taxation of monthly distributions, there's taxation of redemptions. And as you said, Anthony, there's a variety of places this can be held.
Thanks, Fraser. We've hit the 4 o'clock mark, so I wanted to maybe go around the table one more time. If you've seen a question that caught your attention in the chat box, or just had some parting words. So David, back to you first, please.
Well, one of the things I've seen a theme come up in the chat that I am a little bit qualified on is a number of people have said, I want to talk about this with my advisor. And I think it's very important to emphasize that that's both appropriate and necessary. So this isn't a sale of a conventional sale of a product that hopes to bypass your advisor or not have you pay attention to the details and not have you look at all the implications. What we're trying to do here is open up a process of two things. One, that you become aware that the industry, in this case via Purpose Investments, is getting more creative about the issue of longevity. But two, that the principles of you being in control of your destiny, you making intelligent, informed decisions with your financial advisor or not, but certainly with your accountant, your lawyer, your estate planner, your kids, your inheritor, the people that are going to inherit, all of those people have a role to play. And from C.A.R.P's point of view, we certainly welcome that kind of involvement and scrutiny. All we're saying is, be aware of this, add it to the mix that you're looking at.
Thanks, David. Over to you, Fred.
I would say that in my book, Retirement Income for Life, I did come up with a number of enhancements that can ensure that people are not going to be outliving their savings. And frankly, with the second edition, I was a little bit worried about one of those enhancements being annuities. I think this is a great improvement over it.
And just to reiterate the name of the book, Fred, I've seen some questions asking for it.
My third book, Retirement Income for Life.
And that's available on your Indigos and your Amazons?
It's available on Amazon and Chapters Indigo stores, and yeah, pretty much anywhere. Independent bookstores as well, sure.
Thanks, Fred. And Fraser, I wanted to ask you one question and then put it back to you for final thoughts. When C.A.R.P partners with the benefit provider, we ask them to include a discount of some sort for our members as part of that offer. So what is what's the upside for a C.A.R.P member in this?
Yeah, that's great. You've negotiated a nice discount for members. It's 15% off the management fee on an ongoing basis. So I talked about it as 60 basis points. That's to the general public. C.A.R.P members get 15% off, so that takes it down to 51, roughly 0.5%, which is a phenomenal discount, and people should take advantage of that. I've appreciated this. I think there's some great questions here. I've saved the chat, so I'll look at them later. I love reading through questions that people have. Totally echo the sentiment. I don't know anyone's personal financial situation, so I could never recommend this product, let alone how much of someone's portfolio. But we think it belongs in the consideration set very closely, along with other strategies that I discussed today. The one question that caught my attention, just popped up on my screen, was someone said, sounds a lot like a twist on a tontine. Anyone who's familiar with tontines, invented hundreds of years ago in Europe by someone, a gentleman whose last name was Tontine. That is true. It's a true statement. A tontine is just any structured vehicle that lets a group of people share longevity risk. And so in many ways, an annuity is a type of tontine. A defined benefit pension plan is a type of tontine. They've been sort of mocked a little bit in pop culture because there's this sense of a lottery and the last person standing gets millions and millions of dollars. That's not our objective here at all. We're trying to create an increasing income stream for people. But the tontine label is fair. This is a product that insures against longevity risk. And so there is definitely a relationship to tontines, but I encourage people to read about those as well. Yeah. Anyway, it's been a pleasure. So thank you very much for having us all.
Thanks, Fraser. Thanks, Fred. And thanks, David. There's a lot of information in Fred's books and on the Purpose Investments website. So please do take some time to check that out. I feel a bit better about not outliving my money, and I hope everyone listening in today comes away with some new information and a little bit of the stress removed about outliving their savings. So thank you to everyone. Thanks to our panelists, and we'll see you again soon on another meeting. Thanks, everyone.
Pleasure.
Thank you.
Thanks, Fred.
Bye-bye.
Bye-bye.